Zacks rank buys, stocks with a short-term buy or strong buy recommendation. Now, here are more Zacks rank buys. Aggressive growth time now, at least as it pertains to stocks. We're going to be talking with a couple of choices that Bill Wilton, our aggressive growth stock analyst, has brought with him today. And the first one is Matrixx Initiatives, MTXX, the ticker symbol. Have you talked about this one before?
Actually, I haven't. But what they do is they do nutrient and drug delivery systems. So they develop certain compounds that go into tablets, nasal sprays, that allow other drug companies to put their medications into an effective delivery format. They also have a subsidiary that sells Zycam, which is a popular cold remedy, allergy relief brand of medication. I've actually used it myself. It works great. They announced their third quarter results on January 26th. They did blow estimates out of the water. They reported 50 cents in earnings for the quarter, while analysts were only looking at about 31 cents a share. So that was fantastic, and relative to a 7-cent loss in the same quarter last year, things have been going excellent for them in the past 4 quarters, and their sales were actually up 26%, mainly due to the success that they've had with some of their new Zycam cold and allergy swab technologies that they've developed. As you can see here on the next slide, they're a #1 rated company in one of the strongest industries that's out there. The industry rank is 22 out of 217, so anytime you're in the top 10% of the industries out there and you're a top company, you're probably a strong candidate to have a good performing stock. And on the chart you can see that the shares are consolidating near about $16 a share. So we're looking for a sharp breakout to the upside there, especially with an earnings announcement quickly approaching.
All right, and then there is that specialty retailer of casual apparel, Aeropostale, ARO, the ticker symbol, that you feel is poised for aggressive growth.
Yeah, and the interesting thing about this is it's a mall-based retailer. They focus on mainly teenage apparel for more of an active lifestyle, but they also pose a good value. It's somewhat of a cheaper alternative to the Abercrombie & Fitch, which can be a little bit more expensive. Parents are more likely to take their kids here to get them new clothes for school or you know, whatever else they're going to need them for. They did surprise by about a penny, but the thing that I really like about them is that retailers in general have been thrown to the wayside over the past year and a half or so, and there's plenty of stocks like Aeropostale that, you know, we call them throwing the baby out with the bathwater. They've just been getting beat up, yet they're still showing signs of growth. Their sales are increasing, earnings per share is on its way up. As you can see here, it's also a good value. The PE ratio is just over 12, and the PEG ratio is under 0.9, which means that not only are you getting the earnings at a good value, but also those growth rates. And you can see that the current year consensus estimate is about 10 cents higher than what the company earned last year. So they are definitely growing. And on the chart, you can see that they've also got a nice upward trend, much like the previous stock did. And they've even broken through a couple weaker levels of resistance, but they are still resistance, and that's a great sign to see.
If this is a mall-based retailer, malls are having some tough sledding here lately with this economy. If they have no freestanding stores at all, do they run the risk of falling prey to what's going on with mall owners and managers right now?
Well, one of the things that malls are having to do to keep tenants in there is to lower prices for leasing space, which actually can help them. You know, it cuts into their overhead, and you know, not every mall is going out of business. I mean, most malls can sustain themselves for a good period of time without actually going under, just based on, you know, projected revenue. They're able to sustain themselves. It takes quite a bit of time and actually probably some poor management for a mall to actually go under as a whole. So they should be fine.
All right. If you would like to see more of the aggressive growth choices that Bill has, go to Zacks.com's homepage, and over in the upper right-hand corner, you'll be able to see all of the categories of stocks that we write about on Zacks.com. And the headline next to aggressive growth is the one that'll take you to the most recent story Bill has written and an archive of some others. With Bill Wilton, I'm Terry Ruffalo.